I appreciate you checking out this video from NetPicks. Today you're going to talk about the 5-minute chart. And when the question of which time frame is good for day trading, the 5-minute chart is actually one of the more popular responses. Now just think about it for a second. Time-based charts, really, they're just one method of charting your price, right? You can also use tick charts, wrinkle charts, even these things called case bars. But for this video, we're just going to talk about the time-based intervals. And really, there is a huge difference between using a longer-term time frame, such as the daily chart, and these short-term day trading style periods. For example, if we compare a 5-minute chart to a daily chart, there are some stark differences. The 5-minute chart shows price details that the daily chart doesn't show. The daily candlestick chart essentially only had longs available until we hit the highs. And once price started to pull back, we're essentially looking at a bull flag on the daily chart. There's no signs of exhaustion that would set up a potential short trade, so there's really no reason to look short. But when you look at the 5-minute chart, we actually have trading opportunities in both directions during this pullback on the daily chart. Right? There's more trading decisions to be made when you use a smaller time frame. And there's also the opportunity to overtrade, which can be a huge problem for a lot of traders. And then you think about faster chart periods like the 1 minute. It's all going to depend on your trading style and the strategy that you're using. Now keep in mind though, when you think about time frames, they don't really change the overall volatility of the instrument, right? This smaller time frame just makes it more noticeable. So think of the 5-minute chart as using an X-ray on the forming daily candlestick. All right, and that way you can see what is making up the daily candlestick by looking at the 5-minute chart. So as we talked about, and as I showed in that chart, this time period is going to give you a lot of opportunities for a trading day. And here's a disclosure for you. Now, these are hindsight charts, okay? But this chart was advanced candlestick by candlestick. And each decision that was made in advance before the next candlestick showed up. So here is a breakdown of each of these sections. So number 1, this is actually a big move down after a gap up. Consolidation gave an entry for another move down. Number 2, the double bottom succeeds pretty well here when you use a trend line break entry to the upside. The double bottom at number 3, got a rise in price, slight consolidation, and a breakout entry. At number 4, we had a bull flag after a strong run up in price. Don't discount bull flags. They are a really good pattern to be trading. At number 5, consolidation, breakout to the downside. Consolidation after the breakout leads to an entry if you don't take that initial breakout. Number 6, it's a gap down. You get a fast move up, and you get a pullback and a trend line break entry. Number 7, well, now we have a double bottom. The second bottom formed a long lower shadow. It's a reversal. You can just play the break of those highs. And 8 is a strong move up, a pullback, and just using a trend line as a entry tool, right? It's the break of that leads to the trade. So over the course of just 3 days, trading the 5-minute chart, you had 8 opportunities to get a trade on using very simple technical analysis. So with proper risk protocols, it's actually a really good way to build a trading account, depending on obviously how you handle your trade management and your profit-taking exits. Another really great use of this time frame is using it to enter a trade on the basis of a longer time frame setup. So as a higher time frame chart may have an overall trend upwards, the lower time frames like a 15-minute, 5-minute chart, they can actually be trending downwards. And then we can look to trade the smaller time frame chart reversal back in the direction of the higher time frame chart. But there's one thing to be aware of, is the lower time frame can actually trend so much in the opposite direction than the higher time frame, it'll actually break down the higher time frame chart. So essentially what happens is the trend on the lower time frame chart just takes over. So as an example, this is a higher time frame example on the left. We have essentially a bull flag in an uptrend. The uptrend is actually being determined just by higher highs and higher lows. But on the right, the lower time frame is actually putting in lower highs and lower lows. That's a downtrend. Now the right side chart moves so much it actually forced the higher time frame to put in a lower swing low. And it's not yet a confirmed downtrend on the daily chart, the higher time frame chart, but it certainly could turn into one if a lower high is put in. But keep that in mind. So when we look to use the 5-minute chart as our trade entry chart, okay, your entry chart may actually turn the trend of the higher time frame. So here on the daily chart, mark D. It's not a clean pattern, okay, but we essentially have a complex correction that took place. So number one, the day prior, we came into the support zone. So the next day, we would look for a 5-minute chart reversal when the market opens the next day. So number two, what happened, price gapped up on the day, pulled back, filled the gap, put in a failure test of a previous low. That's a trade entry signal upon the break of the high of that candlestick at 2. So number three, if the trader was more conservative or they just missed the first trade entry, a break of the trend line gives another entry. Now your stop loss and your profit targets would be based on the trading time frame, right? The setup time frame. We're just using the lower time frame for a better entry. And the biggest drawback for me on a 5-minute chart is your exposure to sudden price shocks in the market. Okay, we've all seen where price makes a huge price move in one direction and then reverses right back to the other direction. With that kind of activity, a lot of traders get stopped out, right? And given that there are more setups on these charts, traders can often be tempted to revenge trade and then take a marginal setup, right? The more trading decisions you're going to have, the more likely it is you're going to make an error. And when we go even lower, think about a 1-minute chart, that's the territory of the high frequency trading algorithms. We really can't compete there, even though some do try. So the strategy really is to find the setup on a longer time frame chart and use the lower time frame chart for entry. All right, this is when we're thinking about using the 5-minute chart just for the trade entry, not trading off of it. And I actually use the daily chart for all my trading setups. I can come in after the market closes. I can scan through my list of stocks for setups that are going to fit my plan. So I have a list of instruments for the next day. So I just settle in. I have my setups already determined and just look for a trade entry trigger on a lower time frame. Now the trading activity at the open can be pretty volatile, so give yourself a few minutes. Some people use the first half hour just to watch price, but it's the best time to enter a trade if you're using the lower time frame entry. Okay, but just don't jump into a trade. Okay, wait for your trigger into the higher time frame pattern. And that approach that I use, it may actually suit you pretty good. So let's think about a trading strategy for the 5-minute chart. And listen, if you're using a certain pattern on a 15-minute chart, you can look for the same one in the 5-minute chart. Right? If you're trading flags or triangles, it's a pattern regardless of what period you're looking at. Now I know scalping's pretty popular, and yeah, you can certainly scalp a smaller time frame chart, but that's a lot of time at your trading desk for just a little bit of payoff, right? And that's for the majority of you. Scalp is just taking a little bit of a move, right? And it doesn't have to be time frame dependent, right? Scalp is really the time that you're in a trade. You're just looking at smaller price targets and just getting out as soon as price moves against you. Let's talk about a strategy. We're going to use 2 different indicators. We're going to use a EMA. We're going to set it to 8 and 21. And listen, you can use any combination of faster moving averages. It doesn't matter. You can use a 10-20. You can use a 920, it doesn't matter. Okay, there's really no magic here. And then we're going to use a momentum indicator, and for this I'm going to use a 310 oscillator. So all we're looking at is just a natural movement of the market. Price is going to make an impulse move in one direction. Price is going to back off from the high or the low. And then we're going to see another movement in the original direction, right? So we're going to look at 2 different price patterns. Number one is a pullback or a flag. And we're going to look at basing at highs. So the impulse move, that's the first move up, right? We got to see momentum in it. So we can use the momentum indicator for that, for long trades. And we're just going to reverse all this for shorts. So for pullbacks, we look for a pullback without momentum or a strong pullback that starts to form a small trading range. And obviously, if too much time passes in that range, just skip the trade. For basing at highs, we're looking for a strong move up and to see price consolidate at the high of that move. For a broad strokes look at the trend, just moving averages are fine. And you could also use those to have price pull back into them before looking for your trade entry. When we talk about entry prices, targets, and stops, every trader is going to have a different way they enter and a different way they exit trades. I'll give you a standard technique, but ensure that you work out what's going to be best for you. Okay, so for entries, it's a break of a trend line or a break of the high or the low of the past 1 or 2 candlesticks, or just use a strong close on the 5-minute chart. Your stop, place at the extreme of the pattern that you're entering on, right? Or just use an average true range stop. Targets, previous swing highs, previous swing lows. You can use a multiple of your risk, 2R, 1R, 3R, whatever's up to you. Let's look at some. This is Costco. It's a 5-minute chart. Okay, prices moved up off of the open. Our momentum indicator made a new high. So we just expect a simple pullback to form. We see the pullback happen, and either the break of the trend line or the high of a previous candlestick being taken out. It works fine for the entry. Stop loss goes at the low of the pattern that we're entering on. This is a chart of snap, and it's the other pattern that we can look for. We get a big impulse move to the upside, right? Even the momentum indicator shows that. Our large candlestick shows that. And then look at the separation of the moving averages. Price begins to base at the high of the impulse move. Traders can trade the breakout of the pattern with a stop just below the extreme of the pattern. Another move up. Here's an example to a downside. Traders might use options, right? Like a put. This is very clean price action, right? This is the type of movement that you want to consider trading. We get an impulse move to the downside. Indicator makes a new low. We get a rally back into the area of the moving averages. Short a break of the trend line. Short the first black candlestick. Any technique that you prefer will be fine. Now, looking at that highlight section, when you're faced with a day like that mess of upper and lower shadows and the sudden impulse bars in both directions, that's a sign. Step aside. Let the market figure itself out. Now, is it perfect? No. There's going to be trades that don't trigger. There's going to be trades that are losers. This is a stock of United Airlines. Now, this first setup looked good, right? Now, I didn't label this chart on purpose. Okay, so I want you to think through what we're looking at in this chart. Take a moment. All right. So the setup on the left had nice momentum down, right? As seen in both the price and the indicator, you can see it. The pullback was strong, okay? And the sideways movement that we get is welcome. So when you have a pullback that has momentum into it, those can be tough to trade. We get an inside bar. You can see that with the arrow. An inside bar is just a consolidation. You can see it on a lower time frame even better. If you just drop down to a 1-minute chart, what that would look like. You play a break of the high or the low. It's essentially a breakout trade, right? But for this, it's just an entry into a pullback. You get a brief downside move. Then the price just rallies against you, and you probably took a loss on this. Next up, that upside of momentum looked pretty good. The indicator is rising, showing momentum is increasing there. We get price pulling back, failed into a trading range. That black arrow there, that's a potential entry point, and depending on how you place your stop, you probably would have been popped out of this. Now, if you're a trader and you got into this and you're holding through a range, you're kind of a glutton for punishment. Once you see new highs are failing on a long, you might want to think about getting out of there. So to wrap that up, the 5-minute chart, it does have some use as both a trading chart and a trade entry chart. You're going to see some fast price moves, right? You're going to see some whippy price action. Those could be tough to trade. So in my opinion, only traders that are experienced, that could stick to a trading plan, should tackle this chart as their main trading time frame. Now, the strategy we just talked about, you can expand on it, but I really think you should resist the temptation of adding another technical indicator. No, we're simply looking at momentum in one direction, and then we're looking to be involved in another move in the same direction. And as for trade entries, Okay, I don't use lower time frames like this just for entries only, but I'm specific in what I'm looking for an entry. Now going forward, I think you should put together a watch list of instruments and track some trades live. Not real money, just track them live. So in time, what you'll see is price action that suits your eye. Okay, and that's what you should be focusing on. So we all see things a little bit differently as traders. So you really have to know yourself and your biases. Hope you found some use with this. I hope you go through this strategy. Just test it out for yourself. Like and hit subscribe. Any comments or questions, pop them below. Thanks for watching.